Principles of Accounting, Chapter 8. In Chapter 8, we talk about long-term assets. We're going to start this conversation with plant assets. So plant assets are our property, plant, and equipment. They're tangible, which means we can touch them. They're actively used in operations, and they're expected to benefit multiple future periods. So in order to meet our matching principle, to match expenses to revenues, we have to break out their expenses over those future periods. So we have multiple things with our plant assets. One is that they decline in book value over their useful life. So we have the cost at acquisition. That's our historic cost that gets recorded in the books. Then we use it for several periods and allocate the cost of its use over those periods. Then, when it's no longer useful to us, we dispose of it. The items that we can put in the acquisition cost are the purchase price and all expenditures needed to prepare the asset for its intended use. This can include delivery and installation. The acquisition cost is normal and reasonable expenditures necessary to get the asset ready for its intended use. So we'll look at this slide for machinery and equipment. That includes its purchase price, any transportation charges, if we have insurance on it while it's in transit, the installation, assembly, and testing of that machinery equipment, and any taxes on its purchase. For buildings, that includes the cost of purchase and or construction, any brokerage or titling fees that we would have to pay, attorney fees for the paperwork of purchasing real estate, and any taxes on that real estate. Other property, plant, and equipment we have are land improvements. These land improvements include if we buy land and then install parking lots, driveways, fences, landscaping, any lighting systems, sprinkler systems, etc. The land improvements we will depreciate over their useful life. However, land itself is not depreciated. What is included in the acquisition cost of land includes its current purchase price, any real estate commissions that we have to pay, titling fees, surveying fees, property taxes, and any insurance premiums. We will not depreciate land, which is why we keep the things that sit on the land, such as building, fences, lighting, parking lots, separate from the land. So land improvement and buildings are kept separate from the land because we're going to depreciate the buildings and land improvements, but not the land itself. When we have a lump sum purchase, we need to allocate the portions of that lump sum purchase to either the building or the land account because we don't want everything lumped together because we can't depreciate land. So in this example, we paid $90,000 to buy land and a building. So we take the amount that it is appraised for to find the percent of our total. So we have that the land is appraised for $40,000 and the building appraised for $60,000. We add those two together to get $100,000. So the building is 60% of the total and land is 40% of the total. Therefore, we apportion 60% of our $90,000 to the building and the remaining 40% to land. When we depreciate, we're allocating the cost of a plant asset to expense it in those accounting periods in order to meet our matching principle. So on the balance sheet, we have its acquisition cost, and on the income statement, we have the expense of it being used. So remember on the balance sheet, we would also have that contra asset accumulated depreciation. where we store any of the depreciation on property, plant, or equipment. The things that we need to calculate depreciation are its historic cost, the salvage value, and its useful life. Different items have different useful life. Some of that useful life is just how long do we plan on using it for? For example, if we have a policy in our company that computers are replaced every 3 years, then useful life of a computer is 3 years. However, if our policy says computers are replaced every 5 years, then the useful life of computers in our company is 5 years. We have 3 methods of depreciation that we're going to look at in this chapter. Straight line, which we also looked at in a previous chapter, units of production, and declining balance. Straight line depreciation is cost minus salvage value divided by its useful life in periods. So then we have, if we have a cost of $10,000, a salvage value of $1,000, and a useful life of 5 years, we get a yearly depreciation expense of $1,800. So every year on December 31st, we would record the depreciation expense of $1,800 against this machinery. We would do that for 5 years, and then we would have the book value of $1,000 left. Book value is the depreciation or the historic cost minus our accumulated depreciation. When we're looking at the depreciation expense, this is the same every year over 5 years. However, the book value is going to decrease over those 5 years. So after 2 years of depreciation, as we can see here, we would have our machinery at $10,000 less 2 years of accumulated depreciation of $3,600, giving us a book value after 2 years of $6,400. We can see that full depreciation schedule here. We have a 20% depreciation rate, which is 100% divided by 5 years. Then we have our accumulated depreciation every year until we get to our salvage value. So we only depreciate down to our salvage value. So if our salvage value is 1,000, then that is our ending book value after we have fully depreciated that piece of equipment. Units of production is a two-step process. First, we get the depreciation per unit. So in this, we take cost minus salvage value divided by the total units of production. Then our depreciation expense is that depreciation per unit times the number of units produced in the period. An example of that is that we have a machine, same machine with a cost of 10,000, salvage value of 1,000, useful life of 5 years, and we believe that machine is good for the production of 36,000 shoes. So then we would take the $9,000 divided by 36,000 to get 25 cents per unit. Therefore, our depreciation expense in year 1 would be 25 cents times the number of units produced in the period, which are 7,000. When we look at a units of production depreciation schedule, we look at the units produced and sold during the period times the depreciation per unit. And we, again, only depreciate down to the salvage value of the unit, but we'll have varying depreciation expense every year based on the number of units produced and sold during that period. The third depreciation is called declining balance method. Declining balance method has 3 steps. First is that we figure out what our straight line rate is. Well, we know the straight line rate is 20%. So we would have the 100% divided by its useful life of 5 years gives us a straight line rate of 20%. Our double declining balance rate is 2 times that 20%, so 40%. Then our depreciation expense is double declining balance rate times the beginning book value. So in the first year, our depreciation expense would be $4,000. We do not, for double declining, we don't take the cost minus salvage value. We take the 40% times the actual cost. But then you'll see on the schedule that we still don't depreciate beyond the salvage value. So every year we take the book value times 40%. So in the first year, our book value is $10,000 and we have depreciation expense of $4,000, leaving us a book value of $6,000. The next year we take 6,000 times 40% to get our depreciation expense. In the last year, we depreciate whatever is left to take us to salvage value. So that's why the third year is $296 because our beginning of period book value is $1,296 and our salvage value is $1,000. And we never go past our salvage value with depreciation. On this slide, we can look at the three methods side by side. So we expense the same exact amount of total depreciation over 5 years under any methods. The double declining method is called an accelerated method, and this gives us more depreciation expense right at the beginning of the use of the asset. For tax reporting purposes, we use what is called MACRS. And MACRS is a modified accelerated cost recovery system. This is IRS's depreciation method. It's a rapid write-off of an asset's cost in order to stimulate that we make new investments in the company. So MACRS is an accelerated depreciation method, just like the double declining method, but it's a little bit more aggressive. And the IRS sets the rates for that. If you are an accounting major and you take tax and tax 2, you will dive further into MACRS depreciation schedules.